Welcome. I'm Catherine Magana here with J.R. Phillips, which is a special guest with us. He's a local business owner here. We're going to have a discussion on the real estate market with him today, so welcome. We have Rachel Ivanovich and Greg Carroll, where we're also going to give you a brief update on the markets and a little bit of investing and planning ideas. So before we dig in, let's go ahead and maybe have a formal introduction from JR. Do you want to share a little bit about your background?
Yeah, thank you. So JR Phillips, I own a boutique real estate brokerage here in Carlsbad, which you guys are aware of. It's called Phillips and Company. We have 13 agents on staff. Primarily do North County, San Diego, but I also do a lot of probate and trust work with several different attorneys, which takes me all over the county. And we occasionally get up into Orange County, but we're really focused here in North County. We've been doing that for about 25 years. And raised my kids here, as you know, wife, family, and call Carlsbad home and really love it here. And really glad to be here today.
Great, thank you. So before we get into the real estate discussion, I thought I'd give you a quick update of kind of where we're at with the markets. So today is February 12th, 2026. I always mess up the dates. 2026. As of yesterday's close, so yesterday was February 11th. And the Dow Jones, actually from last week to this week, we've actually seen a positive movement. So year to date, the Dow Jones is up 4.28%. The Nasdaq actually is still down year to date. We were down more last week than we are this week, but we are down about 0.76%.
Is that before today?
Right. No, it didn't include anything from today. So this is from last week. And then the S&P 500, we're actually slightly up from last week to this week at 1.40%. And then the Russell 2000, which is the small cap stocks, are actually up from last week to this week. We're at 7.56. But we've seen a lot of volatility and movement in the small cap sectors over the last few weeks. But that's where we're at. Obviously, we're like to see it in the positive. We do see some positive numbers, at least in the Dow Jones and the Russell 2000 right now. Looking at kind of where we're at with interest rates, so the one-year CD is 3.75%, and the one-year T-bill is about 3.55, so not too much change there. And then looking at mortgage rates, so the 30-year mortgage rate we have a slight change. It's actually come in as of today at 6.09%, and the 15-year at 5.44. So that's slightly down over the last week or so, and I'm sure we'll touch on that a little bit during our real estate conversation today. And then looking at the Fed, so the Fed next meeting is March 18th, and that one looks like now that's changed a little bit. So now the probability of no easing, we actually have, there's no change will be 94.1%, and then the probability of easing would be 5.9%. So obviously that's changed over the last week or so. But it was interesting. I was looking, we have heard talks that there will be potentially a rate cut. So it looks like a rate cut between now and June, the probability is down from 75% to 60%. So there are still talks of rate cuts this year, but that may be subject to change depending on the data.
June is the new chairman's first meeting?
Yeah.
Right.
So
That'll be interesting to see how much influence he has on the committee.
So that's where we're at kind of over the last week with kind of the markets and changes and not too much going on. And I know we're closed on Monday for the holiday.
Yeah, the markets, I think right now a lot of the volatility we're seeing, I believe, is because those big hyperscalers, the big multi-trillion-dollar companies are spending so much money building out for AI, the data centers and all these chips, and some of them are actually taking out loans, and I think Google is doing a 100-year bond.
Yeah.
And when a company needs to do a 100-year bond, I think a lot of people step back and go, whoa, how much money are they putting into the ground this year? $100 billion? And when are they going to get paid off on that? And why are these companies that have massive amounts of cash flow taking out loans now? So I think people are looking at that.
I was curious to hear from you guys about what you thought about the jobs report in January. I think it was 165,000, and the little bit that I read said that was considerably more than what was predicted. And then you start to hear all these different opinions. Why?
There's a lot of seasonal adjustments this time of the year. There's a lot of noise with the cold weather that we had. So I think we need to take that with a grain of salt.
Grain of salt.
Yeah.
Yeah, I don't see those numbers being so positive usually, and thought it was a bit of a surprise.
Yep. I think the market did like it for a while yesterday.
Yeah. And then we should be getting numbers tomorrow on the consumer price index, which is coming out tomorrow on Friday. So we'll see where that ends up. It looks like potentially it should be slightly up, but we'll see.
I'd like to just blame it on tax season.
There you go.
Everybody's worried about paying their taxes. Yeah, we got 62 more days of the season. IRS right now, it's about 21 days to get your refund. If you're getting a refund, just wanted everyone to know that. And one of the things this year that's new and is important to know is if you are getting a refund, they're no longer issuing paper checks.
Oh.
So you absolutely have to give a routing number and account number if you want your refund, and they want you to pay online as well. So we'll see how that goes this season.
All right, so let's dive into our conversation on the housing market and real estate. Just note, once again, you're here locally in San Diego. We do have clients outside of this area, but obviously a lot of it does tie in together from a planning and just kind of some numbers. But perhaps you want to share a little bit about what you're seeing and what's happening out there in the real estate market.
I surely will. I think we're about 18 months removed from the big rule changes, which ultimately became a law here in California last January 1st, where if you're representing a buyer, you have to have a buyer representation agreement. And I think we met.
We did.
Right when that happened,
Yeah.
I
Right when
know.
that happened.
And there was like a lot of buzz about it. And
I think if we went back and looked at that episode, we would see that I was saying, take a breath, and I'm not sure. We've been through a lot of changes. And I think 18 months removed, it hasn't really impacted the way that we do business very much. We've just had to change some processes internally. I do believe that the bigger shops and the more corporate Wall Street driven real estate businesses are still trying to get their head around how to take more of the buyers into their portfolio. And I do believe that is going to ultimately force buyers' commissions down. I still don't think that changes much about what a home is and what an investment is, right? I think it may change the way we do business a little bit. I still think it's taking the market a long time to digest it. And I would think the biggest change that we see with regards to buyers have been becoming more and more independent in their searches and their thinking, kind of lockstep with the way that information is available to them. So I would say over the last 6 or 7 years, we've watched buyers become more and more independent, and that is continuing. Buyers quite often like to look for properties without an agent present, which is something that I never thought I would see. What does that trigger and how does that change the way we do things? We went through a rather long period where open houses might not have been needed or maybe weren't what a lot of sellers wanted. Well, because buyers are so independent and they're out looking on their own every weekend, you better have your home open on the weekends. And now, of course, this is price sensitive relative to the $3 million, $4 million, $2 million, depending on the house you have and the type of property you're selling. But that's very important. And then I would say that there's two types of homes on the MLS right now. And it's, if I were to bring my computer in here and go over all the data in the MLS, it would be unbelievably projected at you guys. There are houses that are selling in 20 days or less. And then there are homes that are setting for over 100 days.
Oh, it's a long time.
Wow.
That's a big
And those are your two categories. Wow. And we have to go in and sit with our sellers now and show them that. And it takes them a while to digest that the market is now that price your home right, prepare it properly, or prepare to set for 3 or 4 months.
So is it more of a buyer's market again, or where do you is it kind of a combination, or what are you seeing?
I think you guys have gotten to know me over the years, and I always stay away from overgeneralized synopsis of things. I would say that it's a neutral, traditional market where in certain neighborhoods and certain price points, buyers may have a little more leverage than sellers, and vice versa. If you have a home in a very sought-after neighborhood with very sought-after amenities, that seller's going to drive that transaction and those negotiations. So I think it's kind of a neutral market. I think we've moved into where the market is just more of a traditional market. And you need to, as a seller, paint that front door, fix that leaky faucet. You
Can't get away with not doing things.
You most definitely cannot. And homes that are going on the market, and they are, with deferred maintenance, are being punished. And sometimes the seller, if they don't want to listen to our expertise, they need that firsthand experience. And that's, I think it was about 4 or 5 weeks ago, right around the turn of the new year, it was published that for the first time in 5 years, you probably saw this, Rachel, more homeowners have interest rates on their mortgages above 3% than below 3%.
I was wondering
wow.
about that.
Wow.
So why is that important? Well, when we were getting those 2.5% to 3% mortgages a few years ago, a lot of us in the industry said, well, this is great today, but there is going to come a time where that interest rate becomes an anchor to that seller. And rather than selling a home that they probably would sell, say empty nesters, elderly, they don't sell because they
love the rate.
They love the rate
Yeah.
and the
Of the
financial
house.
component of that home due to that rate
Right.
makes it advantageous to stay. Well, as we get further away from that, we just crossed this massive threshold.
Is 3% really that important, though? I mean,
Well, we're just saying that was the barometer that the data analysts are using.
Okay.
I think right now, I've got several lender friends that are telling me that anytime the rates in the last 2 or 3 months have dropped to 5.5%, and there's only been a few pockets of that where they've had a couple days
Yeah.
here or there, the amount of activity goes through the roof.
Wow.
That tells me, as an industry expert and someone that's been doing this a long time, 5.5% is a magic number
yeah.
for whatever reason, but it's an important number. And I think you were speaking just a minute ago, Catherine, with the rate cuts and where we're at 6 to 5.5 on the 15. I would say we're probably going to see rates stay in the 5.5 to 6 pocket, and that's just the new norm. And I think when we were all younger, those were great rates.
I
Great
remember
rates.
11%.
Those were great rates,
Yeah.
right?
Oh, yeah.
I remember getting my refinancing the third time and getting to 6.25.
Like, yes.
I felt like I slayed the dragon.
oh, yeah.
So
And so I saw a report recently from JP Morgan that talked about basically, and this is more of a national level, that the prices have stabilized. You really you're not going to see a lot of growth. And I mean, obviously we can't forecast, but it seems like it's just kind of been it might be a little steady is what we're looking
and I
at.
think I read a report from economists probably 2 to 3 years ago, and I'd have to dig it up, but they are really good at forecasting where home prices are going to go. And that report that I read 3 years ago has been really accurate with where we're going to go. They're professionals. They know how to look at the data. They understand things along those lines better than all of us. And there is a place where values are going to start to see 3-4% growth. You can't see double-digit growth year in and year out. And that leads us probably to where we're going to go in this conversation, affordability. And affordability is a real thing. And in supply and demand, we all had our econ classes. If the demand isn't there and the supply is going to be impacted, and that's price. So I think we're going to see things steady. I think this year in San Diego County, we're looking at like a 3 or 4%. But you'd be shocked at how many of our clients that are thinking about selling their houses look at that percentage very arbitrarily, and they put it in a spreadsheet and they expect that number. And again, that goes back to what I said earlier. You really have to look at your property, your neighborhood, and you have to be very cognizant of that.
And so looking at, there have been some recent conversations about bans on institutional investors purchasing single-family homes. But I was looking at, when you hear that, you think, okay, that obviously will help, like you mentioned, with affordability and what's available. But the reality is, I didn't realize, but only 1 to 3% of the market makes up the institutional investors. So
I was
think,
reading that same
but,
thing.
but you're thinking, wow, this is...
It's not going to move the needle.
No.
I mean, it sounds good. It's good
It sounds
politically,
good, and I think, again, we spoke earlier about everything's different out in different places in
right.
the country. In certain cities, in certain areas where high-density housing and low-income housing, those percentages change radically within the percentage of investor-owned or corporately private equity-owned.
Right.
I think over the last 15 years, they've quietly purchased 1 to 2, 3% of the annual sales. And they've accumulated now to where they can say sometimes 1 in 4 properties in some way are tied to an institutional buyer
In
or
certain
an
geographic
investment buyer
areas.
in certain geographical
Yeah,
areas. So I don't think I think we're really good at putting light on certain subject matters when it's right. And I think we're at that point where it was time for everybody to say, hey, we got to be careful here, or Wall Street could end up owning a big chunk of most residential homes. And I don't think that's good, because their reason for owning those properties is driven completely differently than why you or I may own our home.
Right.
So we've got to be careful, and I think it's good that we're at least paying attention to it.
Have you noticed any shifts in, lifestyle preferences? Like people are working from home, people are working remotely and moving out of state, and so have you
Absolutely.
noticed any shift?
That started. COVID drove a lot of that, right? We sold a lot of homes and represented a lot of buyers that were released in our market. They were released from the Bay Area.
Right.
They were no longer tethered to their brick and mortar in the Bay Area, and we had a massive influx. What also drove our hot market back in 2021 and 2022 was the fact that they are also a very small percentage of Americans that felt like our real estate in San Diego was inexpensive.
Yeah.
They could not believe how inexpensive our real estate was. So yes, we saw that start about 5 years ago. It's really leveled off. And now what we're having to do is help our sellers, when they prepare their home for sale, present it in a way that shows the home is conducive to working from home.
Right.
They may not do that, or they may do it and their office may look very cluttered. We have to come in and reimagine the home a little bit, and we have to be very cognizant. Where are the little ones? Because we quite often sell a home where the husband and the wife are working from home. There's a child nanny or au pair there helping, and the kids are at home. And that environment is totally different than 10 years ago.
Yeah.
And the home has to be conducive to that. And that may involve some changes that need to be made prior to going on the market.
But then we're also seeing people being forced to go back to work, to the office too. So that
Yes.
might change a little bit.
And we've seen that. We've seen where our clients have spent a fortune on creating home office space. And then they call us and say, hey, can you help us sell some of this furniture? Not really what we do, but that is a reality. Yeah, that is a reality.
I've noticed a lot of these flipping companies like iBuySD.com or whatever they are. And I've got a house in our neighborhood that's been on the market. It's over that 100-day mark for sure. And they've got they're doing their open houses every weekend, but it's a different flag out front.
Yeah.
So they let different agents come in and, try and capture some attention, I guess. But I'm like, it's every weekend. I'm like, how many?
Yeah, you've got a lot of factors going on there, right? You've got an investor that's purchased the home, more than likely to flip it.
Yep.
Over the last few years, we've watched most of these investors go to outside money rather than their money. So when you're using outside money, you're driven or held to a certain return, and you have to get that return for that investor, or you've broken your agreement with them. So they'll hold out for the price. They will hold out, and they'll pull way back on their marketing. They'll pull their sales team off of it, and they'll let third-party agents from other brokerages use it as a setup for the weekend.
Yeah.
It's just one of the nuances of that type of product that's on the market. Those third-party investors are a big part of the San Diego market, the Southern California market. They just are.
I see them a lot all over the place.
Yeah.
Now, surprising. And their commercials are on TV all the time.
Yeah.
I'm like, huh?
They wouldn't be spending the money on TV if they weren't turning a profit.
Right.
I can tell you, I know a lot of those investors and companies personally, and their margins are shrinking. Their margins are shrinking, and they're much more particular about what they buy and the price point that they buy. Going up over $2 million is kind of a threshold for them. They don't want to tie up so much capital. You buy a $2 million flip, and it might ultimately sell for $4 million, but you're going to have to spend $500,000, $700,000, $800,000 preparing the home to sell, and all of a sudden over 120 days you've tied up $3 or $4 million, whereas you can go out and buy 6 or 7 properties, spread your risk,
Yeah.
and turn them quicker. So I know a lot of those entities personally, and that's the strategy that they've been telling me. Doesn't mean that the $1 and $2 and $3 million flips are not there. It's just I find those generally being independent investors that are doing it themselves.
So recently, we've been speaking with some new clients that have been coming over, and I know Rachel's been doing a lot of tax planning, and sometimes it's after they sell the home, they come to us. But it was interesting because we are seeing a lot of women that their husbands passed away, and there's now the step-up in basis. Do you want to share a little bit about that, Rachel, from the tax perspective, what we're seeing?
So we are seeing a lot, like Catherine was saying, we have a lot of clients who have lost a spouse, and all of a sudden they're making that determination. Does it make sense for us to keep the house? Should I sell the house? I just got the step up in basis, and if I turn around right now and sell it, I'm not going to be paying any capital gains tax, but maybe there's so much deferred maintenance on the property. Have you been seeing this in the marketplace at all?
So as our population ages, we do, me personally and 2 of my 13 agents, we do a lot of senior transitioning. I do a lot of probate and trust work. A lot for me. It's a big part of what I do. I have 3 different attorneys. I represent most of their clients. And we are seeing a lot of, I've had 2 meetings in the last week that I could talk about where the seniors are a little underfunded on their retirement, and these decisions, there's usually a nice chunk of equity in the home. It's Southern California, and you might be looking at $500,000 or $700,000 in equity, sometimes $1 million or more, and that money's not doing anything for you. So that's where you guys come in, and we have to work really closely with you guys. We make sure that the transaction goes properly. Giving that type of advice, we leave to you guys.
Well, some of the mistakes that we're seeing, or at least so in terms of tax planning, is both spouses are still alive, and maybe one spouse, they move into, or they sell the house before one of the spouses passed away, and then they've got a huge tax problem versus if you wait until one spouse passes away, then you get that stepped up basis if it's community property with rights of survivorship. Or they're adding one of their adult children onto the title before they pass away, and then all of a sudden that's a gift, so you don't get the stepped up basis.
Yeah.
So
we see that a lot.
Yes.
So we get those calls a lot, and we have to defer to the CPA and to their financial planners, and they have their reasons. They have good reasons, and they have logical reasons why, but that's not what we do. I would never give tax advice, even though I know a lot of the different nuances. I've done this for so long, but there are people that can really be hurtful. Poor decisions.
Tax, and it really hurts them from a tax perspective. But for instance, we have a client that came in. Potential client came in this week, and husband had passed away in 2017. So they did get the full, stepped up basis in 2017. They'd purchased the house originally for $190,000. It was worth, let's just say, $700,000 in 2017. Now it's worth $2 million. So we've eliminated some of the tax issue there. But one of the things that we looked at was, this client wants to move into a care facility that you can buy in, and you spend, a certain dollar amount. Sure. But you also, when you move in, you get a letter that states this is what the medical care for the future will look like. So you can use that as a medical expense deduction in the year that you sell your house. So you can use that to offset some of the capital gains.
That's brilliant.
And so there's
definitely some planning there. So she was able to, and they're listing the house right now, but still qualify for the $250,000 exclusion, even though you owned it jointly, and he passed away in 2017. You only get the $250,000, you don't get the $500,000, but you did get the full stepped up basis.
Right.
So
which is huge.
By combining it with moving into the care facility, she's able to eliminate almost all of the gain.
Wow,
that's fantastic. That's why you need to work with professionals.
Right. Yes. Well, and it is interesting because we've had a couple of conversations about, but they're not even moving yet, but they want to know what's the impact if I were to get out of sell my home, move into these other facilities that provide different levels of care, and there's social and there's reasons behind it. But then we're also taking a step back and saying, okay, well, if you didn't do that, because sometimes people want to stay in their home, how do you get your house set up? What are the costs if you were to stay in your home versus not? And so, and these are really personal conversations.
It's not always about the money.
It isn't.
And
Sometimes
you have
it's
to be very careful when you're having these discussions that it's not always about the money. It's personal preference. And
Right.
we can give you the information. We can refer you to the professionals. And everybody's a little different. There are some people that just categorically want to stay in their home.
So I wonder, because have you seen also, it seems like there's a lot more divorces these days too, so I'm sure that probably ties into...
It's a big part of our business. It's the reality is death, divorce. They're a big part of real estate. And we've seen an uptick in the divorce business, and that too requires really good counsel that works closely with the attorneys and the advisors, a lot of transparency. And we see amicable divorces, we see unamicable divorces. We see amicable divorces that in the last 2 weeks because of the divorce situation become very unamicable. So we see it all. We quite often sell the home after the divorce is final. So depending on the mortgage situation and depending on the financial situation or the children's situation, the divorce may be completed with the home left to be sold by a certain date. So quite often we're selling the house, and the divorce has been done for 2 or 3 years, 4 years, and we're selling the house later because now the kids have moved, and this is what was part of the divorce decree.
Wow.
And sometimes those go smoothly, and sometimes they don't too. And even though it doesn't matter what you think, that was decided years ago. So we deal with all of that.
So is there a certain time of year that if somebody wants to sell their home or buy, I mean, we always hear different things. I mean, is that myth or true, or what are your thoughts? And
I would say, again, that varies where you're at in the country.
So if you're in the winter on the East Coast and you had the ice storm recently.
You're not selling very many homes in the middle of the winter in the Midwest or the East Coast or the North. That's very seasonal. In California, in San Diego, it was very seasonal, more around schooling, around the academic and the children. That was always a component of our business for the last 20 years. That has been accentuated by, I think, the additional information that sellers are getting and how they're interpreting it off the internet. And they are starting to drive more of a summer market again, even in San Diego, because they believe that's the hotter time to sell it. I'm usually pretty good at helping them to understand, would you rather go against 100 properties in May, or would you rather get your property right now in February, price it, you're going to have less competition? Because there's a cliche in our business. It's not really a cliche, but I don't think it's a hard data fact. There's always 2 buyers for your house. January through December, there's always 2 buyers looking in your neighborhood. So it only takes 1. So that we've had a lot of success convincing sellers to go, well, it's the end of the summer, we probably should wait. No, we'll go in September. No, let's get your house properly prepared. Let's price it right. Oh, JR, we got 5 offers. And that's the other thing. A lot of people are thinking there's not multiple offers. Under $2 million, even up into the $2 million, but under $2 million, if your house is priced properly and you've prepared it and there's not a lot of deferred maintenance, you're going to be shocked. You're probably going to see more than 1 offer. And that's really, really hard for people to understand. We've been in multiple offer situations since the first of the year.
Wow.
So are you seeing some people moving maybe to bigger homes or moving in-state? I know we see a lot of people also moving out of state too during retirement.
Yeah, what are some of the trends you're seeing?
We definitely see people who are nearing retirement or in a position professionally leave the state. They are just, I don't want to say fed up and I don't want to be political, but they get to where it's more advantageous to live somewhere else. And if they have that freedom, they're making that move.
Lower cost of living makes a lot of sense.
The grandkid magnet will never go away.
That's true.
Yeah.
So I love how that doesn't come up very much, but I can tell you that our senior clients or our golden year clients are still driven quite often by grandkid location and proximity. That grandkid magnet is a big part of what we do. You don't read about it. You don't hear about it. It's not
there.
flashy, but it's there. So we are seeing we are seeing some trends in that regard. I can tell you we have a lot of clients that have relocated to different states over the last 7 or 8 years. They're also finding, though, that although they may not have a state income tax, their property taxes are generally much higher.
Are they coming
than ours.
I
back?
know.
We have actually we've actually had a few come back.
Oh,
Yeah.
wow.
Oh wow, that's
I'm not surprised.
So they also find out very quickly that when the temperatures are in the 20s and 30s in Texas
They're
or Tennessee,
miserable.
their utility bills are through the roof. And then in the summer, their utility bills are through the roof to cool those properties. So when they really drill down, unless they're an incredibly high earner, that income tax differential doesn't offset the other cost. It's it's not always a wash. But there is a price people will pay to live in this weather, and
Yeah.
it's not as dollar for dollar as what they thought when they moved.
interesting. I've always called it the club. Once you leave the club, you can't get back in. You know, you don't want to pay that sticker
Greg,
price,
I'm going
right?
to tell you, it's cost prohibitive usually to come back.
Yes.
It's very cost prohibitive. So,
Is there anything else you're seeing or anything else you'd like to share?
you know, I think if I'm speaking to sellers, be prepared to spend some money to get your house ready to go on the market. And know that the rule of thumb is if you spend $1, you want to try to get $1.50 back, and work really closely with professionals who have a lot of experience there. I see sellers. I go and look at properties that are on the market that are setting and not selling, and the sellers have obviously put some money into the home, and they put the money into the wrong place. And that, to me, is just when you're working with the wrong professional. But you have to get the home ready to sell, and you have to be prepared for that. And having success, and actually having very quick success, is quite common. And that would lead me to my last statement. Know where you're going to go, the exit strategy. Sellers are thinking that it's going to take 2 or 3 months to sell their home, so they have time, once they start talking to us, to figure out what they're going to do. We quickly redirect them and say, no. We've got to have a solid exit strategy. There may be 2 or 3 components to it, but you got to have an A, B, or C, because we're probably going to sell the house in the first 2 or 3 weeks.
And then it's interesting because we've had a couple of clients out of state here that have moved recently, and they have been in their homes for 20, 30 years, and we're having to take time and pack up, or they did an agreement to stay for a couple months, but there's a lot of stuff that goes along
We
with
negotiate
that.
seller and possession agreements, seller after purchase agreements. We also do what you just said when we're sitting with someone who's been in the home for 20 or 30 years. We ask them what they're going to do with their personal belongings, and they're like, well, we're going to sell it or move it. We need to be a little more detailed than that, because usually they come to the harsh reality that their furniture has very little value, and that's the $10,000 dining room table
Doesn't fit.
doesn't fit,
in the
and
new
it has no resale value.
Right.
And so we try to get into those conversations very early, and we'll even delay putting homes on the market until they have their ducks in a row.
I've got one other question, regarding homeowners insurance.
Yes.
Is that slowing up buyers from getting into new homes?
Absolutely. So California, and along with other states, homeowners insurance has become difficult to get. And it could be more difficult. There's a law that was passed called the Zero Zone a couple of years ago, and there's been a pause, or I don't know what the word I'm looking for. They're giving you time, moratorium, to get your homes ready, but they're going to start enforcing this, and that no vegetation within 5 feet of the house. We don't know what that's going to look like, but I've been preparing my clients and letting them know that they should probably talk to their insurance agents, because I think it's going to shock the market. They're going to start to address this, they're saying, in 2027.
The insurance industry.
Companies.
Okay.
And everybody, so I often hear, well, how are they going to enforce that?
Drones.
Drones, Google Earth.
Yeah.
Everybody can Google Earth every property. They have algorithms written where they can just type it in.
Look it up.
And then they can have the computer tell them which houses they should send a letter to. Wow. So I do believe they've given us a couple of years. It's not just in the fire zones. They're kind of being aggressive and saying they might want to do this in the entire state. So
Houses are not going to look pretty.
No, they're not going to look pretty. I think it's going to foster new businesses that are zero zone specific. How do we zero zone your house? But you could be looking at anywhere. I've read some really detailed articles on this where it could be anywhere from $1,000 to $20,000 to zero zone your house, and that's coming. And I send it to my clients. My clients are all very aware of it. And they're like, wow, I hadn't even heard about this. And it's our lovely state of California where things just happen to pass and you're
then you see it
completely
later.
unaware.
Yeah.
And then you find out.
Yeah, when you say zero zone, what is that?
It's
really?
a 5-foot buffer
That's
around
just
your
a
home.
5-foot
And I don't want to
buffer.
misspeak. I'm not an expert on the subject
Okay.
matter. But it's a 5-foot zone where no vegetation would be allowed
Okay.
within 5 foot
So
of the
no
home.
grass, no ground cover.
Yeah, it would really grossly change the appearance of homes. But I'm sure there will be certain types of plants that are allowed. I would imagine.
Succulents.
And I think we're all
Succulents,
going to
yeah.
become acutely aware of this over the next several months. And I would say that the homeowners insurance hurdle that we were seeing for a couple of years has kind of lessened. A lot of the insurers, State Farm, Farmers, a lot of the bigger have been allowed to raise their prices and have started to, again, work towards taking new policies. So we're not seeing as much of an issue there, but there have been articles in the last few weeks about the California Fair Plan and how it might be grossly underfunded. I don't think that's a surprise. It may not be as easy to work with as was promised. So the homeowners insurance is still there, and it's something we used to deal with that a week or two into escrow. We deal with that now when we're looking at the home.
Yeah.
If we're about to write an offer, we're calling their insurance agent or our insurance agent that we refer to and say, here's the address, tell us what we're looking at.
I have a client who works for one of those big insurance companies, and he's like, we cannot write you a policy. If you sell your house, you've been paying premiums for 30 years, and you move to another house.
Yeah.
They're like, we can't even write it no matter what.
And you would be shocked at the proximity of those homes to the coast and what we would view as non-fire related areas. And it's in our own city of Carlsbad. It's in the coastal zones. There may be green belts and you may be near one and your house is, so it is something that we're acutely aware of, and we have to really help our clients to understand that right away at the beginning. You want to know what you're doing.
Well, JR, thank you very much for being with us again as a
Thank
guest.
you for having me.
Would like to share a website or a way that somebody can get information
Yeah,
from you?
www.phillipsandco-re.com. phillipsandco-re.com. You'll find us there, the whole team, and you'll be able to search for properties. It's a pretty interactive search site as well. And again, thanks for having me. Enjoyed it.
Yeah, thanks for coming back again to join us. And before we end, I did want to share, I know Steve's not here this week, but I do want to share the fear and greed. This week, we actually are at 47, which is neutral. So last week we were in fear. This week we're in neutral, which kind of seems...
I think we're going back to fear next week.
I don't know. We'll see where we
If
end
today
up.
rolls into the weekend.
There you go. And then before we wrap up, I think we shared last week, but Rachel and I are hosting her financial year workshop at the Carlsbad Chamber of Commerce. And we're going to be talking about core values, vision. We're going to do a vision board with kind of your goals for the year. And so we're really excited to come together. And it's going to be on February 25th at 4:30. And you can register at savvyup.com/her financial year. So that concludes today's session. And thanks for joining us. And happy investing.
Thank you.
Thank you.
You.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.